My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. In this business, it's the percentage gain that matters, not the absolute number of points, which is the hope for so many of us who want to see a broadening out of what's working in the S&P 500. Right now, as we get near the end of the year, it's so obvious that a monster amount of the performance for 2023 comes from the Magnificent Seven. That includes days like today, where the Dow gained 204 points, S&P jumped 0.74%, and the Nasdaq pole vaulted 1.13%. The success of the Magnificent Seven is so palpable, so in your face, that people tend to think these stocks are the market. Hey, you know what? For 2023, they kind of were. But how about 2024? Can it change? We'll begin to see money gravitate away from the Mag 7 to other parts of the market. Two things have to happen before we can move on from the Magnificent Seven. Either these huge companies need to stop doing so many things right, or the rest of the S&P needs to stop doing so many things wrong. Both will be very hard to change. Let's start with the seven. It's absolutely true that it'll be hard for their stocks to continue their unbelievable runs. I mean, they've had such gigantic moves, but there's a roadmap. First, these are the companies that can do amazing things with artificial intelligence. They can afford it. I think we forget how expensive this stuff is. And you'll hear all about why it's so expensive when NVIDIA reports tomorrow night, because their super high performance chips are a huge part of the cost. NVIDIA is the brains behind AI, and brains don't come cheap, do they? They spent years and years developing this stuff, so it seems only fair. They'll explain to anyone how the chips pay for themselves almost instantly. But this is a company that reported the biggest revenue miss in the world. Biggest. Except, unlike everyone else, the miss was to the upside. I have no idea what numbers NVIDIA report this time. I just think you need to own it, not trade it. Then there's Microsoft with its Copilot AI platform that costs $30 per month or per user and is already being hailed as one of the greatest productivity programs of our time. I think this company will make a lot more money from artificial intelligence, or else CEO Satya Nadella wouldn't have gone the extra mile to hire OpenAI founder Sam Altman the moment he was fired by his own board of directors. More on that later. Like NVIDIA, I bet AI could help Microsoft deliver some giant numbers next year. Amazon may be able to reignite the growth of Amazon Web Services, AWS, which is bottomed out, by using more artificial intelligence. I also think the real growth here will be in international. Don't hear about that much. Those two things could give Amazon faster revenue growth and a bigger bottom line. Alphabet, simple. They need to get Google Cloud Platform back on track. That's what dinged it last quarter. Any meaningful acceleration could get this stock moving. If Alphabet can quantify how much advertising it's gotten from the NFL and how that could be used to expand sports on YouTube, then it'd be a terrific 1-2 punch. Meta needs to show results from its metaverse business in 2024. It needs to start monetizing WhatsApp in a meaningful way, too. Either makes for a good 2024 story. Tesla, simple. Has to get back on track with its new Model 3. Big sales could easily get that stock up a gigantic amount. I have no doubt that the Tesla hounds would buy the stock much higher in return for some growth. And yes, a return to growth is a really real necessity this time from Apple. And that can come from better sales for the iPhone 15, a good intro for Vision Pro, or the services revenue that are almost as big as wearables, the Mac, and the iPad combined. They have to start become much bigger. In addition, Apple may need to show some dramatic expansion of India to make its investors feel less apprehensive about China. Are these impossible? Actually, I think they're all doable, which is why the Magnificent Seven could have another huge year. That's the game plan for them, and I think they can accomplish it. But how about the other 493 stocks, the S&P 500? I did a long essay this weekend for the Investing Club that traced out the difficulty of staying diversified in this market because tech is so powerful. I think you should take advantage of the Investing Club's Black Friday special and get this piece. I spent a lot of time on it. I think it was over. People liked it. Anyway, that said, you need to know that the solution for the rest of the market isn't about challenging the Magnificent Seven in terms of size. It's about percentage gains. I bring this up because we saw something remarkable happen last week. Shares of Gap stores saw their stock rally 30% because the company's fortunes are turning. It's been ages, and there's been a lot of fits and starts. But this turnaround is taking root. Just a 1% increase in some same-store sales from its largest division, Old Navy, and the stock caught fire. One division. Flagship Gap was okay, Banana Republic was weak, Athleta was a disaster, and it didn't matter. the stock just roared. We don't need to wait to see which is the next gap because so many retailers report tomorrow. But what matters is that the percentage gain from a Turnet or Best Buy or Dixon or Kohl's, that could be humongous. It doesn't matter whether they get to become huge cap stocks. It just cares about how much money they can make you. What about pharma? All right, you're going to need another hit drug like the GLP-1 weight loss injections from Eli Lilly and Novo Nordisk. It's possible, but it might take the acquisition of a biotech company that is something, or the harvesting of biotech that's already been bought. Nothing yet. Maybe next year. I'm counting on it for some of these bigger guys. Some groups need help from regulators. Right now, if the regulators would allow the bigger banks to buy small ones, like J.P. Morgan did earlier this year with First Republic, we would see some very good earnings gains and much better efficiencies. It would cause the whole group to soar. We honestly have way too many banks to even think that we can regulate them well. Much better to cut that number in half and make them easier to supervise. The savings would be immense. The stocks could go up gigantically. The food companies need to merge, too, in order to get their costs down, and the FTC has to realize these deals won't lead to higher prices for you, the consumer. But they need to be allowed to merge because most food companies simply can't keep taking out costs without merging. They just aren't. It's not capable. We need the oils to keep getting together, but it's strange that the Target execs keep taking common stock for the acquirer and not a very big premium. That doesn't work for me. Mergers and acquisitions could be the potential savior for much of this market. Everything from medical devices, industrials, retailers, aerospace, utilities, food and drugs, and so many other groups. Right now, though, the FTC's really been very strong about blocking everything, trying to block any deal that comes in their way. Sometimes just to hold them up before a judge lets them through, and sometimes successfully just shooting them down. It's real difficult to get a deal through quickly at this moment, and that's been the major reason why the rest of the 493 stocks has not done well. Trust me, that's what's going on. The bottom line, if you want to see the rest of the market go higher, President Biden just needs to replace his FTC Chair Lina Khan. But given his pro-worker attitude and the fact that mergers often do lead to layoffs, I doubt he'll go there. Then again, nobody lasts forever in these jobs, so you never know. Let's go to Matt in New York. Matt.
Hi, Jim.
Matt.
All I want for Christmas is to see SoFi stock go to the moon. Where is Wall Street Bets? Where are the hedge funds? And what are your thoughts on SoFi?
All right, look, as I said when Anthony noted, when the stock was at 4, I know Anthony for a long time. He helped bring the Street.com public, and I think that it's doing incredibly well. It's just not being reflected in the stock. That's what you have to keep saying because it's true. Its strength is not being reflected in the stock. It will one day because it always happens. Gerald in California. Gerald.
Jimmy, chill. How you doing today?
I am doing very well. Got a big game tonight. What's happening with you?
Oh, not much. Just working out of the garage. Took some time here to talk to you.
And thank you.
My call.
Thank you. What's up?
Hey, I got a call to talk to you because I need to know what's what about this company. I'm thinking about adding to my portfolio. I did pick them up recently or a while ago as an infrastructure play. They're funded. They were founded in 1963. They're based in Dallas, Texas. They have facilities around the nation. This company is an American producer of building materials, mainly concrete, wall boards, such like that, things like that. So I think they should be doing a bit better. What's going on with EXP, Eagle Materials?
I don't know. Vulcan Materials is on fire. Martin Materials is on fire. This one's not. I think it should be. I like your call. I would be a buyer of Eagle Materials. How about we go to Sean in Ohio? Sean.
Booyah, Jim. How you doing?
I'm doing well, Sean. What's going on with you?
So I just wanted to get your insight. What do you think about Charles Schwab? You know, given the cool and
I think it's so cheap. I mean, I cannot believe. I got to tell you, if you look, anything go wrong with these banks, and we've seen it, and I've made mistakes recommending banks. I just will tell you that I think Schwab at 56 is a keeper. Again, anything go wrong with a bank, and I've had in 2023, I made a mistake with a bank, and I live with it. But I do think that Schwab is an inexpensive stock. Mergers and acquisitions could be the potential savior for much of this market. Right now, though, the FTC is ready to block any deal, even though M&A is really the only thing that would make the other 493 stocks do as well as the Magnificent Seven. On Mad tonight. Now that the retail earnings season is upon us, well, we got to digest every single one of them. And I got to tell you, I've done 2 segments on them coming up because you need to know what to think about this group. Don't miss my take on the latest Ashley cohort. Then, if you think my stock analysis is magical, just wait until you see tonight's guest. Prepare to have your mind blown by the one and only Oz the Mentalist. And last week we learned that OpenAI CEO Sam Altman was being pushed out by his company's board. He created their own company, only getting a job offer from Microsoft to lead a new AI initiative. But what does this all mean for the tech behemoth that is Mr. Softy? I'm breaking down the latest, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.